Hello and welcome back to another episode of Fund Friday with a very special guest. We've got David Thompson, Dave Thompson. How are you today?
I'm doing great, Craig. Great to be here, and I appreciate the invite to talk to you and our investors.
Absolutely. Well, just very grateful to have you on the show today. We've had the pleasure of working, David, for how many years at this point? I want to say
Yeah,
it's like
7, 8.
7 or 8. Since
Yeah,
inception of Lone
all
Star,
right.
you were really there along the way. So, we've basically done everything other than unfortunately play a round of golf together. So looking forward to
Coming
changing
soon.
that. Yeah, looking forward to changing that and obviously working with you more and, with the deals we currently have, but in new investment opportunities as they present
Sure.
themselves. But, want to really learn about you today, how you got to where you are. You've been in Austin, not since, or really one of the longest people I know that live in Austin for about 30 years. So would love to learn
Yeah.
how you kind of got over there and what your origin is.
Sure. Sounds great. Well, I appreciate the opportunity again, Craig. And so, yeah, I mean, quickly, did about 20 years in the corporate world when I got out of college, and I really enjoyed those experiences. A lot of world travel and unique projects and things. But I had always had a passion for investing since as a teenager. I can imagine the first summer job I had, and I remember walked into a Merrill Lynch office with a small amount of money and said I want to put it to work. And I think I got an 8% haircut right away when I didn't even know what was going on. But I went into some mutual fund. I'm like, I need to educate myself. I need to get going on that. But that passion continued. I got an undergraduate degree in actually financial planning, which was a unique major at that time. And I didn't put it to work right away. I was pretty young, and I thought, well, that's a new business, right? That's a whole business opportunity that I would have to pursue kind of as an entrepreneur as I looked into the field more. So I went to graduate school and got an international business degree. But that paved my way into 20 years in the corporate setting, and I really enjoyed those experiences. But after about 20 years, I was really starting to wanted to get in this passion more full time. And my wife and I had been doing some rental properties on the side, and I was starting to understand how that worked. And I was thinking to myself, well, I like it, but as I kept reading and experiencing, it was a slow road, and I would have to stay at my job a lot longer to save the money for the down payment for the next house. And then, you'd have a couple of these experiences where, lots of repairs in one house, and that kind of blows the cash flow. So I think a lot of your listeners have experienced that. So I started really looking in this in about 2015, I guess, is when I started really looking into alternative opportunities and ran across some folks that really kind of could help me mentor into this field. And initially it was just how to buy a small apartment, how to get into a small apartment. And as I looked into that and these programs and, kind of doing 6 months of work and looking at things, I'm like, this is a team sport. I can't I don't want to do all this stuff. It looks like another job. It's like, I didn't want like a part-time job, but I wanted something that was really just right in my wheelhouse. And
Yeah.
I had bartended my way through school, and I liked talking to people, and I liked finance, but there was other areas like, just sitting behind spreadsheets all day or looking for needles in a haystack on deals. I'm like, that's not really where I want to be. And I think operationally, I don't really be managing a big team of people either. I like my freedom. I want to be able to travel and do things with my spouse, and the kids are older. And so I ended up finding out and getting a chance to work on an opportunity with an operator way back. And we were like, okay, you're going to need to learn how to raise capital. I don't care what you end up doing in this business. That's still the bread and butter way to, you can find a great deal, but there's no money to do anything with. It's kind of wasted time, right? So that's how I fell into the syndication world. I immediately liked the deals that we were working on. I was like, wow. And when I would talk to friends and family about these deals, I quickly understood too that no one knew about this stuff. We grew up with stocks, right? Bonds and, IRAs and 401ks. But, I found this fascinating world of commercial real estate and alternative investing is something quite unique, and something where I could see, some people could benefit holistically from putting some of their money into these assets. So I felt like I'm pretty knowledgeable. I had a degree in finance. I had a financial planning kind of background. I've always been interested in personal finance and investing on my own. But how can we get more exposure to people to learn about this, right? So I approached it more from an education perspective. And the first time I raised money on a deal, I surprised the person I was working with. They're like, wow, you did pretty good. And I was like, well, I don't like sales. I got a sales job out of college, and I just absolutely didn't like it. So I'm like, well, I went to graduate school instead. So I really shied, Craig, away from those types of roles. And but I found out, I think if you like something and you're just wanting to just educate people on it, then it didn't feel like that kind of role to me. It was just like, how can I help you learn more about this field?
Yeah, you're really doing more product information and why this is
Yeah,
a superior way to go about it, as
yeah,
opposed to saying, hey, just buy this and it's going to change your life. It's like, well, these investments could definitely change your life in a better way, but
yeah,
it's more just the general holistic approach and view to it, and why, it is quite essential to be a part of these deals, a part of these private placements,
yeah,
especially to consider the fact that, now it's a little bit more mainstream. I would say multifamily investing, apartment
yeah,
investing. There's certainly a lot more information, courses, groups, masterminds,
sure.
networks, meetups, places to be in regard to the space. But I'm sure
Mhm.
when you got into it, it wasn't so. So it was kind of like a calling on your behalf to share something you organically came to educate people in this alternative space, particularly when you factor your background there, financial
Yep,
planning, and how, this is a vehicle to do that. So
right.
speaking of the timing and whatnot, when did you kind of start to educate yourself personally on the apartment space and stuff like that, as you alluded to? When did you kind of stumble into this?
Yeah, I mean, I think originally when we were the first group I was working with was strictly a value add apartments, right? So finding older apartments in the 1980s and renovating them and eventually exiting these assets in 3 to 5 years. And that was kind of like, to me, a slow flip. Kind of as I talked to investors, that niche to me was something that a lot of people could grasp and get their hands around because figure someone had probably been a renter somewhere in college in a dorm or an apartment experience now. A lot of people are in apartments, and so they understand the business model, right? I live
Not
there.
rocket science.
It's not
Yeah.
really complicated. I live there. Someone who owns the building. We have expenses we got to pay. We got to pay the rent in exchange for I get to live in this nice place. So that business model was not too complicated, and I think that was easy to start. Yeah. But with my financial planning hat on, I was thinking to myself, well, I was thinking about diversification. And what I always wanted to do with investors was I always wanted to put my money where my mouth was. I always wanted to invest in the deal because investors will, not every investor is going to ask you, but they're probably either thinking about it or they're going to ask you at some point is, do you invest in your own deals that you're presenting? And of course, yes, that was something I always wanted to do at an early point because I was like, well, if I like the deal, why shouldn't I invest in the deal? Obviously there could be money issues, but if I can invest in the deal, I will feel much more comfortable because I'm going to go do the due diligence on it. We're going to understand the marketing information inside and out, the underwriting, and those kind of things. So I started with that, and these deals were all in Dallas.
And
And
this is in the 80s.
this was actually so we started doing this in 2016.
Okay, gotcha. So you
Yeah.
found this kind of space
I left
later
the
on
corporate
after
world about
you became.
2015, and
Okay.
that's when I got kind of these mentor programs, kind of learned about syndications, and I found a role that I thought I could that resonated with me, and I could do and fit my lifestyle, and so that's how I started. And then, but it was always Dallas for a while. It was always apartments, and it was always working with the same operator at the time. And so I was thinking to myself, that's great, but I can see in my own portfolio I was getting concentrated. you know? and so I was thinking to myself, okay, over time, if I like this business, I can see where it would benefit my investors, myself and my investors, to work in different geographies, because there's different economic cycles going on, right, in major cities and regions around the U.S. Definitely different operators. I mean, at that time, I think we were, you don't want to kind of an experience like I always call it the Bernie Madoff experience or something, where it's just, seems legitimate and it's not legitimate, right? So we really carefully vet our operator partners, of course, but you just don't know what you don't know, right? So that was something that was important. And then not just apartments, and there's a lot of great things out there: self-storage, mobile home parks, industrial, you name it. There was a lot of different things. And I also like some alternative stuff, just some things that were a little off the grid, but I thought the risk profile could work. And so that my business is, fast forwarding now 10 years later, over 100 syndication deals we personally invested in, shared with investors. And we've kind of layered on a couple things. I mean, I was talking to you kind of before the call about, some things we've learned over this last 10 years, because I was very fortuitous and fortunate to get into a situation where the market was we had a big tailwind when I kind of came in
Yeah,
2000.
basically, you started doing it. Trump got into office, rates started getting cut, and there was some pretty good GDP. And then,
Yeah.
as we know, COVID happened, and then the force multiplier comes on, right?
Yeah.
Rates go to zero. So basically, any property that you
Yeah.
probably bought well and invested well and did thorough due diligence
Yeah.
on from basically 2016 to basically 2020, well, yeah, 2020 on an acquisitions perspective was, you bought it and turned it to gold, right?
You're absolutely right. You really didn't, you couldn't, I don't want to say you can't miss, but
It was essentially, yeah.
rising tide lifts all boats concept, it's just like you want to be playing it at the same time when everything's kind of going up. And that lasted at least, I would say, for me getting into the business, and then another 6 years on top of that. So it gave me a good, I think timing is a lot to do with a lot of things in life. And that particular time was a great way to get exposure to a lot of investors who at the same time were benefiting from the low cost of capital that these operators were getting into. And then, we had relatively low interest rates at that time. And now, I think there was also a housing shortage that was pretty much in all of the marketing materials. And even to this day, there's a housing shortage
I
technically.
hear that all the time. Yeah, I think if you're in the real estate business,
So that
all
was
you hear, all
yeah,
you hear in the real estate business perpetually
right.
is that there's not enough
Yeah.
units,
Yeah.
and replacement cost is now X, and you can't make affordable housing. And the 80s and 70s stock and 90s stock
Yeah.
is going to be workforce, and so on and
Yeah.
so forth.
Yeah. And then we kind of see the flip side of that as we go into, obviously we've had these podcasts before with your interviews, but with your listeners, but, then everything was really smooth and almost, everybody was being rewarded well up until about right when rates started going up. That was like this March of 2022, right?
Yeah,
And then
right
that,
when I got into the business.
yeah, but that kind of peaked. I think the rates peaked in 6 months later, so it's like September 2022. So where deals kind of bought in that 2021 to mid 2022 period, those were challenged, because all of a sudden, if you're in a variable rate loan deals with me, I should mention apartment investors were in and other niche operators were doing at the time, it kind of made sense. Um, and then we're talking about the supply. So that's crazy. Like I'm sitting in Austin, Texas right now. And, and 3 years ago, we had so much influx of new headquarters coming in. I mean, I guess the marquee name would be Tesla coming down here and Elon Musk moving the headquarters and, Oracle headquarter down here.
X move, Meta has offices. Everyone has
Yeah,
offices.
I know. If you were in Austin recently, I'm sorry I was out of town and missed you, but if you go look at this, every time I drive down to Austin, the skyline is completely different. Now that they just over the weekend, the tallest building in Texas just started on its 68th floor. It's going to 76. So just a lot of growth, and that growth brought in a lot of new supply, and so we went from kind of being the darling down here in Austin now to being like maybe the most oversupplied market in the country, kind of its own chapter, I think, at the end of the day. And so you're seeing, we were talking to one of our property managers, for instance, he says, we actually see rents at the 2015 level in Austin on like apartments. And he's with one of the fifth largest apartment operators in the country. So, and they're headquartered here in Austin. He's been in the business about 4 years. So they're pretty knowledgeable people. So it's hard, it's hard to see that change, but it's a 3-year cycle, and you're kind of going through this cycle. But these are a couple other things I think we've learned. Kind of coming back to our initial discussion point was now talking to investors, or had you invested over that whole 10-year cycle that I've been in the business, you've done really well in the beginning. If you bought during that 18-month period, prior to interest rates, you're probably struggling with no distributions, maybe some capital calls. That's obviously we're hearing a few about those things. There's some foreclosures out there. Those are kind of tough things for investors to think about, wrap their heads around. But what we also learned is at that time, and I love there's a lot of tax strategies, right, with real estate, and I still like them, and I'm an advocate of them. The 1031 exchange is great. We'll talk to investors about, hey, we got a personal property, like to do some of that. So, I still like that. But we also had a bunch of sales, as we were peaking, kind of like surfing, as we're going to the top of this crest. And including, I'm invested too. And, we would take advantage of the 1031 and we kind of roll into the next deal. I think that works. But you just got to be careful kind of where you are in the cycle. And it's
For
hard to
sure.
know where that cycle is. But then
It's
you
all
kind of,
also, I mean, debt related, right?
yeah,
If you've maybe two extra money in a quick period of time and you're going
yeah,
to tender an exchange, I
yeah,
think a big lesson to learn here, nugget hold on to is
yeah,
if the next business plan has a shorter term debt structure or, doesn't
yeah,
make you feel 100% comfortable,
yeah,
then, run away from it. Maybe
yeah,
even accept a lower return structure knowing that the
right,
next deal could be caught at the wrong point of the cycle. You don't want to be in a situation where you have a big return and then it gets knocked down by a deal not going exactly how you want it to go.
yeah,
And that's just part of the investment process, as you said. I think the fundamentals of apartments are still great. The
yeah,
thesis has not changed. People
right,
didn't get dumb overnight. It's just a interest rate environment that no one forecasted, coupled with
right.
a supply
Supply.
issue, kind of
Yeah,
created this story today.
yeah,
But let's backtrack a little bit. Let's go to diversification, right? So being in the business for 10 years of the capital raising side, you've kind of looked around. You had the issue yourself there of, hey, I might be oversaturated
hmm,
in that market of Dallas you mentioned, right? And then it sounds
right,
like you maybe did some deals in Austin. But
right,
talk about the journey from finding other kind of operators in other
right.
locations and doing deals maybe outside of your backyard or
Yeah,
down the street, if you will, within Texas. But
yeah,
can you talk about the story of diversification, different partners you've worked with,
sure. Yeah.
and just basically maybe the importance and the thesis behind how
Hmm,
you would
hmm.
personally spread it around and some lessons that you would encourage other people to kind of
Yeah,
listen.
no, that's a great segue. So one of the things I, we're talking to investors and we'll have a call and pull up their portfolio kind of things that they invested with us before. And, I'm happy to see when they have certain components in the portfolio of things that, zigged or zagged or when other things zigged or, doing something a little bit different, right? Not correlated. And the most obvious one was, okay, people who were still maybe investing in apartments, but they did it up in the Midwest, for instance, right? And I remember talking to investors and like most of our deals were in the Sun Belt. I'm from Phoenix and I'm living here in Austin, and we had operator partners in Atlanta and Florida, and it was like everything you was reading, like everybody's moving to these parts of the country, lower taxes, business friendly, and it would be a challenging discussion sometimes when I told them we had a deal up in Michigan. It's not real. It's not going to be. We think the profit potential and the cash flow potential is still within the ballpark of what we've been doing, but it's just different. It's a fixed rate loan, and the growth rate is not as fast as in the Sun Belt. It's kind of a steady eddy, and they would kind of go okay, and some people wouldn't do it because it's like they can't get their wrap their heads around something, a different region that they wouldn't normally think about. And we had a lot of success in those types of investments, not only because the fixed rate structure kind of looked really nice when when not affected too much by what's going on with interest rates, so you kind of took any kind of, I don't know if you call speculative risk off the table in that regard. But the Midwest rents didn't see the supply coming online that was depressing the
Right.
rents, and so we could have moderate rent growth and continue without having this kind of up and down. And so it was a smoother ride. But the operator also did a few things unique. I mean, they did take their time. There was not a lot of competition in buying deals. That was another thing we learned. Very interesting. So there's not a lot of growth there. So there's not about a big buyers coming in looking for deals. So you're usually buying older assets. But what this group really specialized in was they were buying a lot of mom and pop. They started out buying like 30, 40 units, but then they would put it into a big fund. And so they would create scale. So if they bought right from the mom and pop, who may have been handed this, down through generations, who knows how people got in the
Yeah,
problem.
they've
Maybe
had
they had
it.
it, but
Maybe they don't want it anymore. Maybe they inherited it. Yeah.
yeah. And you think about it is that they, mom and pops, they're not, 30, 40 unit. You don't have on-site management typically. You may, but you don't. So maybe the customer experience may be a little slower. You're paying retail prices for everything, snow removal, whatever, pest control. So if you put it into a big fund, you may have 500 to 1,000 units. Some of these deals are bought all cash. some fixed rate loans. So you had a modification there, but a little bit lower risk profile. But they just reduced the cost of everything because now I can hire a full time maintenance person to watch the whole portfolio, and now I'm paying wholesale prices. So that's kind of an example of something unique. We're still investing in apartments, but it's a different part of the country. It wasn't affected by competition, not affected by rents. Certainly was more steady eddy, but you can still carve out a pretty good return over time with people, and so that's worked out well. I also liked some other assets. Industrials have had a really nice run.
Industrial has been one of the biggest darlings as well, as you mentioned.
Yeah,
Especially COVID really increased that. The only issue with industrial is easy to put up four walls and a roof, but other than
yeah,
that, I mean,
yeah,
no toilets, no tenants to really worry about per se. It's
yeah.
triple net, and with the boom of Amazon, particularly during COVID, that business got
Mhm.
super hot, right?
Yeah, yeah. Fulfillment centers was big. This was the one actually we ended up getting involved with was a group that did a sale leaseback, and what they did was they were creating a portfolio of like 20 commercial properties, all industrial properties. And I remember touring one in Texas outside of Dallas, and I think it was the town of Claiborne. But this plant was it will be a bit. This company was like a typical maybe Warren Buffett company. It had been around for many years, and they had a whole risk profile of analyzing what deals they would go after. They would make sure they were diversified different industries and stuff. But it was like these companies would do like one or two things, and it was like this company made fences around utility plants around the country, and they've been doing it for years. And the fences were made out of concrete, but it looked like a fence. It was just like I was like, this is all these people do. They have a couple things around highway stuff, but it was just kind of boring, cement kind of companies. But here was the play. The play was this, and I think private equity gets into this. The play was, okay, I'm sitting on this company. I want to grow. I may not have the cash. I've got all this stuff in physical assets. And if I want to go buy equipment or hire people to grow, I may need capital. And so this company would come in and they'd say, we'll buy your building. We'll lease it back to you on like a 10-year triple net lease. So that kind of helped us with inflation, right? So the tenant's paying all of the inflationary factors around the property. And sometimes they would help them fix it up, whatever they needed to do. And they put it on a 30-year fixed loan. So that kind of did fairly well over the last few years because as rates were rising or higher rates, they were able to kind of take that fluctuation interest rates off the table, long-term 30 years. The sale leasebacks came in. So it's a pretty nice cash flow model with some upside at the end when they'll start selling these assets off. But some of the private equity companies actually go in and want to run the company. This is not that. This company only does the commercial real estate side. But and that's kind of interesting too, with like the Trump and the onshoring and all that kind of plays into that, right? If there's going to be a renaissance in manufacturing, or just more jobs in the U.S., I think that kind of plays into that too, right? So
100%. The thesis is there without a doubt. I think,
yeah,
a lot of retail, unless it's really core and anchor, tier one retail, like retail you're talking about, like a
yeah,
Fashion Square in Scottsdale or a Scottsdale
yeah,
Quarter or whatever the big development is in your city, to talk about if you're in the Bay Area, it's a place called Santana Row. I'm sure there's a couple of complexes in Austin that's got, core tenant of Whole Foods and the Lululemon, stuff like that. That retail's great, but kind of the more strip mall stuff like that, Amazon's really cutting into that pie. So I'm happy to talk about the diversification. And then as we're on the diversification, we also talked about this in the lab, but just, and you kind of alluded to this before, but just, making sure that you don't go all in all at once, right?
mhm,
Stacking, if your plan is to invest X amount of dollars, you don't put it in two deals in 1 year or in 1 quarter. You put that over a period of time, you
yeah,
dollar cost average in because, you're eventually gonna, be a little high, a little bit low. You're going to find equilibrium over the course of time there, right?
mhm,
If you keep making your contributions. So,
yeah,
can you speak to maybe that and some
yeah,
lessons there, particularly
perfect.
as mentioned?
Yeah, perfect. I mean, so we were talking about that 18-month period, right, of being kind of an interesting time, and maybe you're getting in there at 2021 and to mid 2020.
I mean, by the way, you're hearing about to invest in multifamily probably right when it's maybe not too late because there's never a time too
Yeah,
late, but too soon if
yeah,
you're going to go all in or at the wrong time if you're going all
yeah,
in. But if you're doing this over the course of time with chunks,
yeah.
you will be okay over the course of time.
That's right.
It's, yeah.
That's right. And I think like, these deals that were bought right before the high interest rates came in, and, the rents have been negative in some of these Sunbelt markets for the last few years. And we see that changing over the next 2 or 3 years as a supply kind of, they call it fall off the cliff, or not a new construction going on with the higher rates. Is we can see like over a 6 year, 7 year, you're climbing, you're out of it. But in general, most of the deals are kind of offered as a 3 to 5 year kind of thing. So it's not that we feel like most of those types of deals, you're just going to be in the deal longer. Yeah, waiting for that recovery, and hopefully you have a strong partner that can kind of stay in the deal and rework things with the lender. But I think that, like, again, talking to investors, and I love the investor, if we have the benefit of a couple things, it's easy talking to investors who came in kind of like, especially when we're talking apartments or some of these other niches that we're kind of relying on more inexpensive financing with kind of a slower flip kind of project. Those folks, everything. I have some investors that came into me like 2023. That was their timing. They heard about me. We started talking, and pretty much I feel comfortable when I look at their portfolio from 2023 till today. We're on solid footing. Why? Well, okay. Well, a couple of things. One, we haven't really had rates go up. They've been kind of steady Eddie,
which is fine.
right?
It's stagnant's
So
better than going up. Yeah.
We expect them to go down. If they go up moderately, it's fine. All these models are kind of baked in some increase in interest rates because we want to be conservative. But let's just say now you're kind of at the top end of the interest rate curve. Well, that's great. This is when we want to be entering the market. If we're at the top of the supply oversupply, which we think that's going to happen and start burning off, then we're seeing some great deals. Some of the operators now are coming up and we're buying distressed assets. We're buying from sellers who couldn't stay in the game. And it's unfortunate for their investors. But we've all been in deals where we're on both sides of that, right? But you also want to be out there doing things now when you're kind of nervous. And I have investors that were just kind of invested in that 2021, 2022, and their experience, if they just invested in that time period, not before, not 2016 to 2022, when it was like everything seemed to work. And we certainly have investors who invested with us over the 10-year period. So they know it works, and now they're experiencing a little bit of a downturn here. And then if they continue to invest with us, they're also getting in deals over here that we're taking advantage of on the other side of it. So I think that's huge. It's not easy to do. We know it's not like a stock. I'm going to put $1,000 on all these types of deals, right? So we know our minimums are a little bit more in our space, in our world, syndication world. 50,000 is usually a minimum investment. We can get investors in for 25. You have that flexibility from time, but we know that the typical investor we deal with, they may have a 1 or 2 shots a year, because they're doing some other stuff, which they probably should be in their stocks and other things that, we're not experts in. But if they want to allocate whatever they want to allocate, it's just nice to know that you should be, in my opinion, looking at all this. We've talked about different operators, some different geographies, maybe some different niches that we've been talking about. But the time period is important, right? The time period. If you just only go in at one time and you experience it, it's almost like if you got in the stocks and you just got in because, they always say, well, a taxi cab driver was talking about stock tips. Yes, everybody knows about it now. It's probably a top.
Whatever the caddy's telling you about, you got to invest in XYZ because, some guy hit it big there before and that's the greatest thing. It's like, well, yes, he sold, he realized it. And now there's other people that are, holding the bag, and that guy will be back into it again.
Yeah. It's that dollar cost averaging. I don't know if it's not, they're not, these are illiquid investments. That's another challenge too. So people like, once I'm in, you got to stay with it, and I think actually it's funny. It's a different thing about the liquid nature of it. I think that's an advantage because if you look at the stock market, if you talk to people and do all these, look at any kind of research on the stock market, most of these people will say your real return in the stock market for most people is like 2-3%. And you're like, how can it be? The S&P is like 11%. It's because we got access to it. It's liquid. We get emotional and buy more when everything they're telling us about at the party, everybody's telling us about stocks. It must be going well. I put money in, and then it craters and you can't take it. You open up, you can sell with a button. So the real estate thing, I really believe long term the liquid nature is a benefit, but it can be painful at times, and you have to be patient. And it doesn't always work out, but I think in the general sense, the experience it'll work out. I think to a point where, and some of these deals are tough. I think you just got to be patient, get your money back. We're happy with that. And then if you're going over a 10-year period and just doing a little bit each year for 10 years, you'd have, in my opinion, you're going to have a much better chance of getting in at the right cycle on most of these things, where you're going to be probably fine over time. Yeah.
Yeah, and I think that's the lesson to learn here from someone who's been in a decade is there are going to be good times and bad times. You've seen several market cycles. You've seen several, economic differences. You've seen wars. You've seen basically what, the world can throw at, a economic forecast and, a rate environment, right? But, that if you do this over time, the world works itself out. Things are cyclical. So if you're scorned from perhaps doing deals at the wrong time, you are like everyone else. And if you've not experienced it yet, because you're just getting in the market now, well, you're lucky and listen to the notes, the pros like, Dave or the team here at Lone Star being able to navigate this time very, very much so.
Right. And maybe the last one, Craig, and I think I alluded to it, maybe we had talked about a little bit, is not only the timing, but, the amount you put. I see some people who they ask me, if you were, you're showing me maybe a couple deals, which one would you do? And I'm always like, be careful about that, because this is you. What are your risk tolerances? What kind of makes sense? What have you done? Have you done a lot of deals in Dallas? Maybe you look at over here. You've got.
Well, I love that thought. I mean, I get asked all the time when I do new investor calls. And I'm like, okay, you ask good questions. If you're in, in the capital raising business or any sales, you ask questions. You learn what the goals are. And sometimes I hear people are going to invest 300,000 or they have 300,000 to invest. I'm like, okay, well, what's your plan? And they say, well, what do you mean? I was like, are you going to invest 300K at a time? Is this, a pool of, call it 1.2 million? We're going to do 4 deals. Or is this, 300K and that's your allocation for the year? Because if that's for a year, you kind of be silly to go all in one deal, all in one location. Yes. What if I said we've got a deal here and then we'll probably have a deal coming up in 2 months? It probably makes sense for you to divide that because, wholeheartedly, I could tell you I love this deal, but I don't know what the outcome is going to be. Right. I don't know if XYZ is going to around the corner. Like, you're just historically better off to split that out. Is that kind of what you've experienced as well?
I would say that's right. And I got a specific example of something like that, because I've had a deal. Our best deal was bought in Phoenix in 18 months, and I think it turned like a 75% profit. Right? There's like I've 100 deals.
It's a figure in a quick period of time.
Yeah, it's like, that's just not going to happen. That might be a lifetime experience. In real estate, that's just crazy. That's fast. And that was when we had one of the years was, if you remember this, the rent growth was like 18-20% across the Sun Belt. Like, it's just like, I feel bad for people at that point. I was like, what?
That plus a compressed cap rate. That's a force multiplier right there.
It's a force multiplier, right? And then, but that deal, I went out and I toured with the operator. Like I said, I'm from Phoenix and I knew the area. And it wasn't a bad area. Not that wasn't the case. We don't do that. We don't be in those kind of situations. But it reminded me, when I saw that apartment, it reminded me like the old Howard Johnsons. It was like, it was 2-story, but like you could walk up and knock on everybody's door. There was no elevator. It was just like 1970s, stripped down. It might have had a pool, but I don't think it even had a pool. 100 units. And I'm like, what are we going to do with this? And the operator was going, well, we're thinking about we can take the master bedroom, just like it's a one master. We can take the bedroom and we can add a washer dryer and create a partition wall and add a small washer dryer. I thought that was creative, but I was like, it shrinks the size of the bedroom. I'm not really sure. So they only did like 4 or 5 of those units, and the market was just driving up so fast. They just sold it. And I don't know what the real outcome would have been had we had to, 50% of the units had to, go through this renovation. And then flip side, we've had a deal in Austin that didn't perform, but and it was a deal where, it was also, I'll tell you a different story. We had a deal in Dallas. This was a while back, and the property was beautiful, and there was opportunities to do some value add to the interiors and things, and I'd have investors who are in both deals, and they happen to be going by, why would you ever do that Phoenix deal? That's the ugliest property. Why would you do this one? Because people have a connotation that they might, if they ever had to live there.
Yeah. Hey,
it's not about beauty in this business.
Yeah. Mobile homes are great investments too. That doesn't mean you want to live there. We've all invested in deals before that, yeah, we've all invested in deals before that you wouldn't want to, necessarily live in, or if your family member
Yeah.
lived there, but
Yeah.
that's not the assignment, right?
Yeah, that's right. So you be a little careful there. I think it doesn't necessarily. I mean, obviously, looking at the neighborhood and things, if you're uncomfortable, that's probably a good sign that. But they always do say that if you can find a C class asset in an A class area, or that's a good area. That has a a way of working in your favor potentially, because if you can make that C plus, maybe a B minus by doing certain things, you're kind of moving up into the demographic that's already there, right? Versus going the other way. You don't want to buy a really nice gem in an area that's deteriorating, right? So it is important to look at the asset, kind of where it's at, but just by looking at it and saying I wouldn't live there, is not my experience. Is it does not matter sometimes. What's the business plan look like? What's the potential, right, of the asset? So that would be a sharing experience, right?
Yeah, with that said, what are investors interested in today? Because, the flavor of the day, the soup of the day will change. I remember we were, very fortunate in 2023 and 2024 at Lone Star, where we're able to do, great deals with tax exemptions with
Yeah,
local housing authorities. And that
right,
was kind of the big flavor. And then debt investments in industrial got popular as well. But,
right.
what are you seeing today that investors are looking to kind of park their cash in?
Yeah, I mean, I still think if you can redo. We talked about interest rates. I think if I can show a deal to an investor that might have all cash components or much less leverage or fixed rates, I think that gets their attention because some of them have been scarred a little bit by that. But now I think at the same time, like we talked about, it could be a really good time to do this value add stuff. So I still keep that on my radar screen. We still show investors that. Um, I think to show investors, like we didn't talk really about alternative assets. So one thing that I got interested in, and it has some mixes of those components, was a dental fund, right? So that's completely off the radar screen. And it takes investors a little bit more time. Like I don't even know anything about the dental industry, but I'm here to educate you on a little bit of it. But I started liking that because they were what I had learned. Again, coming out kind of a time period where I think investors were looking about a little bit more certainty in cash flow or trying to get some higher cash flow opportunities and things, then you had to look for businesses that were a little higher margin businesses. And what was going on in dental was what's called a dental service organization. And I didn't know a lot about it either. I just know I would see dentists around Austin with this company, the same company name. So I'm like, okay, I figure corporations are involved in the dental world. And you see that in the medical world, right? So and the thing is like I could talk to investors because I'm like, I get it. Okay, a dentist or a doctor, they're busy, and you want them focusing on you. You don't want them spending time thinking about marketing and doing all the back office, dealing with insurance companies. So that made sense to me, right? If we can just keep the doctor focused here. And then I realized this group, they like to buy, the margins were like 15%. Okay. So that's a high margin business, teens, that's a high margin business. And if you can buy them all cash, because they're only like $1 million per practice, they're not like these big, huge things. I mean, there are larger practices, but if you can just kind of pick off mom and pops in a general area, and you can tell investors, okay, well, there's no leverage here, right? So, okay, if you're worried about leverage before, there is no leverage. And what are you doing with the asset? It's value add. Well, okay, I have a value add apartment. What are you doing? It's the same thing. We have a company that really knows how to market, and we really have a part of our company really knows how to handle billing to increase your collections from like 90% to 98%. It's just like value add. I didn't realize it's like that.
You're consolidating expenses, you're
Yeah,
professionalizing it, you're corporatizing it, you're putting systems in place, and you're just
yeah.
basically picking up little shops here and there
Yeah,
sporadically throughout
and
certain geographic.
consolidating them.
Yeah.
Exactly. Then what I'd learned too is that, well, a lot of the dentists who, if you start getting to higher margin things, Invisalign, some different things, some of them may farm that out. It's like, okay, I'll farm that over here. They may get a referral fee from them. I don't know. But if you have now a fund that buys up all these little practices, and you start buying some specialty practices in there to do the higher margin stuff, crowns and all that, you keep all the revenue in a pool, right? You're
Well,
not
those are higher ticket items, and then you
right.
refer it out to other synergies. It's perfect.
Yeah,
It's a match
yeah,
made in heaven. And if they like you, if you have a good practice, well,
yeah.
of course they're going to use your XYZ referral, your
Right.
crown, your root canal, your so and so specialist that you have within your
Yep.
own business there, particularly if you've got a captive customer.
Yep. And then the last thing I learned when I was looking at the industry was there's a low failure rate, and it can happen, but there's, if it's less than 1% versus a lot of businesses are much higher than that. So that's what I think. I was trying to get some investors who may have been through that, some experiences where they came in at a bad time, or so I was just I'm trying to migrate into a few things and this partner, by the way, that does this, I've known for many years. So again, I'm trying to be, as you grow with experiences here, I've shrunk the number of people I work with. I mean, it started out kind of a wider moat. And then as I learned about, that niche, maybe not really, I think it had the durability, or this operator, I just don't really like how we communicate. And, that's okay. And
And some relationships aren't meant to last forever, unfortunately. We all
yeah,
strive
Craig,
for
that's
them
a good
too,
point.
but there's just differences of opinion,
Yeah.
differences of how you want to handle certain things. Then also
Yeah.
you get the benefit of reference. You get the
Yeah.
benefit of comparing and contrasting. Maybe Lone Star Capital does something way better or way worse than a different
Right.
sponsor, and then
And we certainly, yeah, that's a
yeah,
great
we
point.
always want feedback as to how we can be the best,
Right.
comparative to our respective, competitors.
Absolutely. And, our relationship's endured 7, 8 years. Like, I met Rob way back. We were just kind of getting in the business, and I like they were in Texas because that's where I am. I wanted some, a couple alternative operators, and I certainly like you guys really took advantage of some of the opportunities in Houston around like the property tax exemption programs that were there at the time, so it's been a good run, and we'll continue the relationship. I like the way it works, and I evaluate. And I listen to my investors because my investors are saying, well, communications are good or bad. Report visibility and transparency is really important once they get into a deal. How are they handling the challenging times? If there's a challenging times in the marketplace, either locally or going on macroeconomically, what's going on? And I definitely will favor, and I see my investors want to favor people and groups like yourself that are out doing things. They're very visible. They're sharing, educating, and you guys certainly do that. And the operators I work with and have grown and shrunk this to groups that I really like follow those attributes because, you want everybody to have a good experience. And, we don't know how these deals are going to work out. Honestly, we don't. I can't tell you from this deal I look at. I think overall, it's going to be a good experience for everybody. If you do enough of these over time, different operators, different geographies, different time, different niches, I think it will work out because I always look at it as like, this is my money and my reputation and my brand. And, it happens. It happens once in a while. You may lose money or whatever. And it's a deep frustration and it's tough. But I think people appreciate that. Typically what happens, it's not the operator. You want to blame somebody. I get it. It's not really the operator oftentimes. It's all this stuff happening around timing, the market, whatever. If you can endure it, I think you'll come out okay. You'll learn some things, not be too scarred, and continue to do this. Investing. This is what I was talking to someone the other day about. This is the experience of investing isn't to be 100% right and make a ton of money because that's not unrealistic. It's really unrealistic. But if you did the stock market for many years and you just kept in there and not messed with it, I have a really interesting example. This is interesting. When my daughter was like 3 years old, I think I opened up one of those 529. I don't know. I can't remember the numbers. It was like 528 with the plans college education savings plan, right? And I put it with a reputable, company indexed. Just put it all in, put it in every year, put it in. Meanwhile, I have my 401k at work, and I'm in there looking at it all the time and changing allocations and doing things and
getting cute with it.
15 years later, it's time for college, and I'm looking at her portfolio, and I'm like, she did fantastic. Her percentage returns is much better than mine.
Yeah.
In fact, if I just put it in there and not mucked with it, and just trusted the experience and the whatever in time, I would have done much better. And that kind of gets back to, if you do a bunch of these different things, trust the operator. They're going to do the best they can. Situations will kind of ebb and flow. Most of the time, I think over time it'll work out. But people have a hard time sometimes. Kind of, you want to. So the experience may not be going quite right. You want out. I just want to. But that, I think it takes kind of the emotionals out of that. Takes some of the emotional out of it. And when the things are going great, this is not a time to, sell everything you have and put everything into our deals.
Yeah, I think my life goal is to invest and never sell. Never sell anything. Just keep adding.
Yeah.
Not trying to hit the grand slams. Kind of set it and forget it. I do
Yeah.
believe in the stock market and putting dollars away there.
Yeah.
I'm in the process of, do I do construction to my current house, or do I just make it a rental and buy another house and start
Right.
stacking those, right? The answer is it doesn't matter as long as you keep buying it and holding it and setting it and forgetting it, and you'll look up one day with exactly what you want and more. With
Yeah.
that said, Dave, appreciate you being on the show today. Where can people learn about you if they want to find out more about yourself, investing with you, your story, and maybe your experience with Lone Star Capital or other operators?
Yeah, that's great. No, I think the best way is I'll give you my email. So it's David at thompsoninvesting.com. So Thompson Investing is all one word, THOMPSON. You see it on the screen there. And we do have a website, Thompson Investing. But send me an email and just let us know how we can connect, or if you'd like to learn more about kind of what we're doing, and like to learn about you and see if it might be a fit. I'd love to talk to. That's my favorite time of just to talk to investors. I just really enjoy that. I learn a
Yeah.
lot.
Absolutely. Well, David, thank you so much for your time today. We appreciate having you on, being such an awesome partner. Looking forward to hopefully getting a round of golf with you in soon
Let's
and
do it.
having more wins together and celebrating those successes. To those who've been listening to the show, we appreciate your time and we'll see you next week.
Thanks, Craig. Appreciate it. Thanks for having me.